Imagine this. You had lost money in the business but still had to pay the taxes. This sounds unfair, right? But what if I told you that you could actually turn this into a future benefit? Today I will explain you the most misunderstood finance topic, deferred tax assets and deferred tax liabilities, using a real life story that even a 10-year-old child can remember forever. Meet Mr. Ravi. He runs a small delivery van business in Hyderabad. In year 1, he makes 10 lakhs rupees of profit. But for the tax purposes, the government lets him claim extra depreciation on his van and say it is 6 lakhs. So Ravi, according to the accounting books, he has a profit of 10 lakhs, while on the tax books, he has just shown 4 lakhs. You may ask, how is this 4 lakhs? 10 lakhs of according to the accounting books, and 6 lakhs he has got outright on depreciation expenses that he can show as an expense in his books and deduct it from your profits and show only 4 lakhs as his profit. He pays tax on this 4 lakhs now and feels good today. But Ravi knows that he won't get that big depreciation benefit in future years. This means he will have to pay more tax now. That is called as deferred tax liability. This means he'll have to pay more taxes later on. This is deferred tax liability. Less tax today, more later on. This is like borrowing from the government. Now comes year 2, a tough year for the business, and Ravi books a loss of 3 lakh rupees. But the tax officer disallows some of his expenses. So for tax, he still shows a profit of 1 lakh and pays tax on that, even though he has actually lost some money. That tax he paid today becomes a deferred tax asset. Why? Because he can use it later when he makes profit again. It is like a gift card. You had prepaid taxes now and government lets you to redeem it later on. Here is a 1 minute cheat sheet. Deferred tax liability is pay less today and owe more later on to the government. Deferred tax on the converse is pay more tax now and save more later in the future period. Deferred tax is a timing difference and it is not the fake money, it's just shifting the tax between the years. Alright, finance pros, let us see if you are getting it. Here is a question to you. Which of the following creates a deferred tax asset? A. The company claims higher depreciation for tax. B. The company pays tax now on income not yet earned. C. The company's expenses are disallowed for the tax but recorded in the books. D. The company has identical income for tax and books. I will give you 5 seconds to think about it. Hope you have got your answers. The correct answer is C, because when your expenses are disallowed now, you pay more tax today and recover it later on. This is a deferred tax asset. Drop your answers in the below comments and tell me if you have got it right. If you want more such stories to be explained without the boring financial jargons, subscribe and turn on the bell icon, because finance does not have to be boring hereafter anymore. Comment Tax Ninja if you have watched till the end. I will reply to every of your comment.